The Indian rupee, which has registered a worst single-day fall in over a month, the currency did slide all the way to 60.86, but is back slightly and it did see pressure because of the strong dollar demand by oil importers. The rupee shut shop, though nearly 0.25% down at 60.76 on your screens. Let's get on board then. Vijay Bambani, who's author and CEO at bsplindia.com. Also joining us is K. Harihar, who's head global markets, First Rand Bank. Mr. Harihar, hi. Let's start with you first. And what's your sense on the kind of slide that we are seeing in the rupee? 1 month lows. We have seen the strength come back in case of dollar. Would you say it's just about the oil importers' demand that's putting pressure?
Partly yes, and if you look at today, yes, definitely. The last couple of days it's been oil demand. There has also been reportedly talk of defense demand coming up and also the month-end demand. But I think the process actually started very slowly, from the day the trade deficit actually came up. The markets which had actually got used to that $8 billion per month number saw a number of 10.4 on the board. And looking at the backdrop of the fact that the GDP seems to have bottomed out, there is a little bit of a fear that oil imports and non-oil imports, which are both pretty low for quite some time, may actually start perking up. So that started the whole process. The second thing that has contributed in a big way is that the debt funds, the money that came into the debt market, which have always been positive for the last 3 months, have started turning seriously negative, partly aided by the fact that treasury bill and commercial paper, you can't put any more new investment. And more importantly, because the corporate bond market, which logically should have got all the money, it's facing a little bit of a question mark out there thanks to the new circular which has come out, on creating a firm underlying security as well as the other rules which are on reserve creation. So that has led to a paucity of issues in the marketplace and therefore absence of FI money coming into that market. I think that's also contributed a bit to the whole process. So it's not like overseas cues have damaged the whole thing or the dollar index or even the small problem in Ukraine, but it's more domestic factors and broadly in a situation where the FI seem to have pumped in enough money based on an expected outcome in the coming elections. So there's a question how much more money comes in, and in that market the demand has been much more than the export supply. But having said that, exporters are selling. The forward premiums have actually come down in the last 3 days from about 8.04% for the 1 year sector down to about 7.93 today close. So exporters are also taking advantage of any weakening and continuing to offer at every higher level.
Well, that's about the domestic market, and as you rightly said, there are more factors here than outside. But even then, the dollar index is trading at a 2-week highs. If you look at something like a Japanese yen, that's a 1-week lows. Euro is trading at a 2-week lows. The Chinese yuan has declined quite sharply, nearly to 14-month lows there. Are you looking at the scenario really building up around everywhere?
Yeah, there is a confluencing of factors. So if you take the dollar yen, the yen trade data that came out a couple of days back was absolutely bad. Exports very flattish and imports very up. So that was one positive in favor of the dollar. Again, Ukraine, while there is temporary truce that's happening, people are not too sure how the longer term view of this will happen. And Eurozone continues to say that they will come out with their version of QE3 and therefore flood the market with a lot of money. We are expecting there is an outside chance that the ECB might do something out there. So the dollar has a relative strength against euro, seems to have a strength against the yen, and China also looks soft with a series of data that came out. So the dollar index, while not expected to fly away, is slowly gathering strength, all in a backdrop where the calendar for a monthly pullout of $10 billion seems to be very well established. Even if in the shorter term we're going to see soft money markets, as the new Fed governor has clearly underlined, that until she sees a firm uptick in the US economy, the short term will be soft. But all of this leads to a feeling that the money will eject out of the emerging markets. We've seen first eject and then a little bit of comeback, and now marginally selectively playing around the emerging markets. So the bigger play really, if you take a 3-month view, is has the FI money all come in upfront? Is the export growth going to kind of taper off a little bit if the rupee strengthens? We are caught in those debates, and therefore you see the little bit of pullback on the dollar against the rupee in the local markets.
So while you did talk about the domestic markets, and while as you pointed out, the factory numbers have not been good, the inflation has been on the higher side, but what do you make of the all-time highs Indian equity markets and the rupee's non-participation in that?
That is for me?
Yes, Mr. Harihar.
Yeah, Manisha. As far as the dollar rupee as the stock market indices are concerned, we have seen the FI money coming in, but if you take the last 3 months as a number, more money has come in actually into the debt markets, and we've not seen that kind of a money coming into the debt market. So the worry there is, will that money eject out? Will the monies get rolled over? As far as the equity market is concerned, there is a broad assumption that the GDP has bottomed out and the reforms are firmly in place. There is stability expected in the new government, and therefore that equity money is going to remain more stable. The question is how much more money will come in as a result of a new government coming in, but for that we'll have to wait till May 16th to figure out the future direction of that. But it's a very important day because any upset outcome out there could actually cause a negative sentiment out there in the dollar rupee market, in the stock market, and from there into the dollar rupee market. So the market wouldn't want to think of that as an outcome, but if it is a positive outcome or a outcome as expected by the market, I think the current trajectory of rupee strength will continue, but in a more gradual and calibrated way.
Vijay, getting you in the conversation as well, it's the worst single day fall in 2014 coming in for the currencies, what we've seen in the last 24 hours. How is it looking on charts and how are people trading it?
Manisha, the most noticeable thing about the currency trade today has been that all the 4 currency pairs traded on the currency derivative segment on the NSE have logged higher volumes. Now the trader participation has returned, and we've seen the test of 60.90 levels on the USD INR. It's a level that I talked about being the upper limit for the dollar to appreciate. We've closed fairly comfortably close to that level. So now, in spite of the truncated weekend kind of a mood tomorrow, my guess is that you're likely to see strength in the dollar remaining in the session tomorrow. If the equity markets are either sideways to marginally weak, the rupee might weaken a little more. So I'm looking at a probability of 61.10 in the prompt month futures on the currency segment on the USD INR. I think the other factor to note is that the euro versus the dollar is showing signs of attempting to kind of strengthen against the dollar, and that will be reflected on the euro INR as well. If the euro INR was to go above 84.60 and stay there comfortably, my guess is the euro might just appreciate a tad more. So, which overall leads me to believe that the rupee might remain subdued in the coming 2 or 3 trading sessions.
So, Vijay, what is the kind of range you would watch out for now?
Where the dollar is concerned, I think the scope for appreciation of the rupee will now be limited to 60.20 or 60.25 levels in the prompt month futures. Where the strength in the dollar is concerned, I think 61.10 to maybe 61.20, give or take 10 paisa here and there for emotional turbulence is a range that I would look out for till Friday.
Mr. Harihar, how would you look at the dollar index? I mean, you pointed out that it's not flying away, but we have seen it holding between that very narrow range of 79.5 to 80 for many days now.
If you look at the fundamental data that's come out from the US and also the fact that all the actions that have happened in terms of pullback of the QE3 money is actually a consequence of clear visible data in the US economy. We can debate whether it's 2.4% GDP growth rate or a 3% growth rate, but the growth rate is very firm. It's widespread, unemployment numbers coming down percentage-wise, actuals-wise. So that is not getting reflected fully in the dollar index. If you look at all of that and translate to a dollar index, it should be much, much higher. So that's a little worry in the marketplace that when that dollar index starts reflecting that, and probably the trigger will be when there is a signal that the short-term easiness in the money in the dollar market will also go off. She's pushed out the calendar to actually next year, 6 months after the QE3 shutdown. But the first signal you have that, you could see a dollar index spike happening.
Okay, so strength in dollar index expected, and the rupee actually is under pressure because of lots of factors, as our experts have been pointing out. Mr. Harihar, we'll let you go with that. Thank you so much for joining us with your sense on the currency markets.